Hello, everybody who is joining. Thank you for joining us. We're going to be starting in just about a minute. Again, to all those joining us, thank you for joining. We are going to be starting in about 1 minute. I see a lot of people are joining. Just a heads up, we're going to be starting in about 1 minute. And for those already joining and have heard me repeat myself 3 times, I promise that's soon to be over. Okay, we're right about at 4 p.m. For those who have joined us, thanks a lot. If you've gone to our prior webinars, we appreciate you coming back. And if this is your first one, then get ready because you are going to receive a lot of great information. Mark Henschwitz here is the expert when it comes to student loans. For those who've been here a while, I've heard me say this a million times. But Mark, he's testified in front of Congress. He is quoted oftentimes by major outlets such as the Wall Street Journal and Forbes. He's the go-to person when it comes to student loans. And in today's webinar, we're going to be reviewing forgiveness options. So I know a lot of you are going to come with cases, personal examples, very specific questions. Ask away. When we transition into the Q&A period, I'll leave out personally identifiable information. But I do challenge you guys to try to stump the expert here. Mark really does have the answer for every single question, I promise. And without further ado, I guess I'll let you kick it off, Mark.
Thank you, Julian. So today's talk is about student loan forgiveness and discharge. And after the PowerPoint presentation, we'll do Q&A. And if there are any questions that I don't answer because of lack of time, I will be writing articles about based on some of these questions, obviously anonymized information and more generic. So join our student loan newsletter and you'll see these articles showing up over the next few months. We're still writing questions for the previous webinars. So student loan cancellation refers to the end of a borrower's obligation to repay a debt. And there's 2 types of loan cancellation. There's loan forgiveness and loan discharge. They differ depending on the reason for the loan cancellation. We'll describe the differences on the several next slides. Now, loan cancellation differs from loan deferment and forbearances. Loan cancellation is a permanent end to the repayment obligation, while loan deferment and forbearance are temporary suspensions of the repayment obligation. So let's talk about what's loan forgiveness. Loan forgiveness is earned through service, such as working in a particular occupation. The service is often in a national need area, such as addressing a shortage of qualified workers in that area that is of strategic importance, often in impoverished neighborhoods. Right? You might receive loan forgiveness for working as a public school teacher in a low-income neighborhood or teaching in a high-need subject area where there aren't enough teachers. Loan forgiveness can also be based on the duration of the repayment. Now, the occupations for which one can obtain loan forgiveness, they often involve low pay and high debt, and that debt would otherwise prevent people from being able to pursue a career in the field. So the idea is to remove the debt as a barrier. Now, there are 2 main types of loan forgiveness, upfront and back-end. Upfront loan forgiveness cancels a portion of the debt for each year of service as it occurs. With upfront loan forgiveness, the borrower may receive a partial loan forgiveness even if they don't complete all the years of service. Back-end loan forgiveness cancels the remaining debt after a number of years of service. With back-end loan forgiveness, the loan forgiveness is all or nothing. Some institutional loans that are made by colleges may also include loan forgiveness. And for example, Tufts University prides itself on public service by its alumni, and so they have created a loan forgiveness program that meshes very well with public service loan forgiveness. So let's illustrate the difference between upfront and back-end loan forgiveness. This chart compares a proposed reform to the public service loan forgiveness with the current design of public service loan forgiveness. Public service loan forgiveness is an example of back-end loan forgiveness. LRAPs, that's student loan repayment assistance programs provided by employers, and Perkins loan forgiveness is an example of upfront loan forgiveness. And as you can see in the upfront column, every 2 years, a portion of the debt gets forgiven, whereas in the back-end loan forgiveness, the forgiveness occurs at the very end and is only of the remaining debt. There may be differences between upfront and back-end loan forgiveness in the amount that is paid by the borrower until the forgiveness is received. Generally, upfront loan forgiveness is going to be better for the borrower, and back-end loan forgiveness is going to be less expensive for the lender or the other source of the loan forgiveness. So here's some examples of existing loan forgiveness programs. Public service loan forgiveness, as I said, is a back-end loan forgiveness program that forgives the remaining debt after 120 qualifying payments in a qualifying repayment plan while working full-time for a qualifying employer. Teacher loan forgiveness forgives up to $17,500 in federal Stafford loans for teachers who teach full-time for 5 consecutive years in certain low-income elementary and secondary schools. So in a way, it's a back-end loan forgiveness because you have to teach for 5 years before you get the forgiveness. It's limited to new people or new borrowers as of October 1 of 1998. So if you have loans prior to that date, you're not eligible. The $17,500 of forgiveness is for special education and STEM fields, science, technology, engineering, mathematics. Otherwise, the amount of the loan forgiveness is $5,000. If the service began on or after November 1st of 2004, the teacher must be highly qualified, which means either full state certification or licensing, at least a bachelor's degree, and having passed a rigorous state test in the relevant subject matter. Perkins loan forgiveness is a form of upfront loan forgiveness, or it's actually a whole bunch of different Perkins loan forgiveness programs. And it's for working full-time in certain jobs and other occupations like public service, teaching, police, fire, EMT, public defenders. And it's like that example I gave in the previous slide, except it's over 5 years instead of 10 years. It forgives 15% of the loans the first year, 15% the second year, 20% the next year, 20% after that, and then the last year is 30%. Now, there is loan forgiveness for volunteer work. This tends to be partial loan forgiveness, not full forgiveness of the debt, but examples include the AmeriCorps Vista program, Peace Corps, and there's also independent organizations like sponsorchange.org. There are many loan forgiveness programs for doctors and nurses and other health professionals, but it's mostly for working in an area of national need, like an area that doesn't have any doctors or nurses. And these programs include Public Health Service Act, Nurse Corps Loan Repayment Program, Indian Health Services Loan Repayment Program, NIH Loan Repayment Program, Veterinary Medicine Loan Repayment Program, and the Health Professional Loan Repayment Program for the U.S. Navy. Loan forgiveness programs for lawyers are mostly focused on public defenders, prosecutors, and other types of public interest law. A prominent example is the John R. Justice Student Loan Repayment Program, which is offered by the U.S. Department of Justice to public defenders and prosecutors. Loan forgiveness for people who work in government agencies is through the Office of Personnel Management, OPM. It is similar to the Student Loan Repayment Assistance Programs, or LRAPs, in the private sector. This loan forgiveness program, the amount varies by agency, but it can provide up to $60,000 in total loan forgiveness in the form of $10,000 of loan forgiveness each calendar year. The borrower must commit to working for the federal government agency for at least 3 years. Members of Congress and political appointees are not eligible. And it's especially popular among employees of the Department of Defense, the Department of Justice, the Department of State, the SEC, the Veterans Administration, and Health and Human Services. The armed forces, the U.S. Armed Forces provide what's called SLRP. It's the Student Loan Repayment Program. And that provides up to $65,000 in loan repayment instead of the Montgomery GI Bill benefits, if the borrower scores at least a 50 on the Armed Services Vocational Aptitude Battery Test. The amount of loan forgiveness does vary based on the service in which you enlist, and it must be requested on your enlistment documents because you're opting out of GI Bill in order to get it. Loan forgiveness in the income-driven repayment plans occurs after 20 or 25 years of payments. That's 240 or 300 payments, and it's got to be in the income-driven repayment plan. And under current law, this forgiveness is taxable income to the borrower. So you're substituting a tax debt for the education debt. Employer-paid student loan repayment assistance, which I've mentioned several times, is known as an LRAP. It typically provides $100 a month as a recruiting or retention incentive for employees. Now, the Teach grant is a little bit of a misnomer. It sounds like a grant, and they're giving you money up front, $4,000 per year if you have at least a 3.25 GPA and are in the 75th percentile or greater for a college admissions test. But it's really a forgivable loan because if you don't fulfill the teaching requirement, which is to teach in a high need area, STEM, reading, bilingual education, foreign languages, special education, for 4 of the 8 years after graduation, it's retroactively turned into an unsubsidized federal direct Stafford loan. And so that can make it twice as expensive as if you had borrowed the loans in the first place. Now, there's also some loan forgiveness options provided by cities and states. I've listed several of the states and a few of the cities that offer these benefits. The goal is to encourage people to move there, especially to development zones. And these loan forgiveness programs are provided as state income tax credits usually. They may be limited to specific occupations and have income limitations. For example, Maryland is limited to first-time homebuyers of state-owned properties. New York's loan forgiveness program is for people who operate a New York farm for 5 years. Now let's turn to public service loan forgiveness. There are 4 key elements to public service loan forgiveness. You have to make qualifying payments, 120 of them, which is 10 years worth of qualifying payments, while simultaneously working in a qualifying public service job. You must be repaying the loans at the same time in an eligible repayment plan, and your loans must also be eligible for public service loan forgiveness. This loan forgiveness is tax-free, so it's a pretty good deal. Loans in the FFEL program are not eligible for public service loan forgiveness. Federal Perkins loans are also not eligible. However, you can consolidate them into a federal direct consolidation loan, and then they will qualify. On the other hand, private student loans are not eligible for public service loan forgiveness, and you can't consolidate them into the direct loan program. So the qualifying jobs include police, fire, EMT, that's emergency medical training, members of the military, public health, teachers, social workers, public defenders, prosecutors, public interest law, Head Start, and librarians, public librarians. The income-driven repayment plan earns forgiveness while standard repayment is there in case you no longer qualify for income-driven repayment. And standard repayment effectively preserves the forgiveness that you have already earned. So if you're in a standard 10-year repayment plan for 10 years, well, and there will be nothing left to forgive. It is the income-driven repayment plans, which have monthly payments that are less than the standard payment amount, that earn you some forgiveness that you get at the end of that 10-year period. Now, you may have heard that very few borrowers qualify for public service loan forgiveness, and that's true. As of March 2020, just a few percent of applicants for public service loan forgiveness have been approved, just under 3%. And that combines, there's two versions, public service loan forgiveness and the temporary expanded public service loan forgiveness. And I'll explain what the latter means. Now, most of the rejections have been for borrowers who haven't been in repayment for 10 years. Well, if you haven't been in repayment for 10 years, there's no way you could have made 120 qualifying payments, because there's 12 months a year, 10 years, that's 120 months. So many of these cases, it's borrowers who were just applying, hoping that the forgiveness fairy would forgive all their loans without really paying attention to the eligibility criteria. Now, the temporary expanded public service loan forgiveness allows the borrower to qualify if their loans aren't in standard repayment or income-driven repayment, but rather in extended repayment or graduated repayment. But only if the loans during the last year of those payments were at least as much as they would have been under an income-driven repayment plan. They originally, extended repayment and graduated repayment were not part of public service loan forgiveness, but because borrowers complained that they were misinformed about the eligibility criteria, what repayment plans counted, Congress passed this special fund, which still hasn't been exhausted, to allow for some loan forgiveness for borrowers who are in the wrong repayment plan. Okay. Now, we're in the wrong repayment plan and your loan payments during the last year are higher than they would have, are lower than they would have been under an income-driven repayment plan, well, there is a solution, which is you switch into an income-driven repayment plan for the last year, and then you will qualify after that year. And given that most of the money has not been spent that Congress appropriated for this, if you hurry up and do this, you will potentially qualify if you've done 120 payments and it's just that you were in the wrong repayment plan. Now, there are many reasons why applications for public service loan forgiveness have been rejected besides the number of payments. One example is government contractors. People think if I work for the government, I should qualify. But if you're not working directly for the government, but rather for a government contractor, you're not eligible. You have to be working for the government agency directly, or if the contractor is a 501c3 tax-exempt charitable organization, you'll qualify. But if it's a for-profit contractor, no, you will not qualify. Part-time jobs do not qualify, except if you have a combination of several qualifying part-time jobs where you're working in a qualifying position for a qualifying employer. It will qualify if you work for a combined total of at least 30 or more hours a week, which is the definition of full-time employment. So you can put together several part-time jobs to qualify for as though it were a full-time job. And there's also special dispensation for teachers who may not be teaching during the summer. If they're considered full-time employee by their employer, then it counts. And the payments must be made on time, which means within 15 days of the due date, while you're employed in a qualifying job, and the payments made, only payments made since October 1 of 2007 will count. Payments made during a deferment or forbearance do not count. However, the special payment pause and interest waiver that is in effect now through September 30th, those payments do count because the CARES Act included a special provision to count them. The extension that was just announced by President Trump through the end of the year, it is not clear if that's going to count towards public service loan forgiveness because they're basing it on the economic hardship deferment, which does not count towards public service loan forgiveness. Now, if you don't file the annual certification paperwork by the deadline, some of your payments will not count. So you need to make sure you get it in by that deadline every single year. Now, if you make multiple payments as one lump sum, it's going to count as a single payment. This is called paid-ahead status. And the only exceptions to this is if you get a lump sum payment because you were serving in AmeriCorps, the Peace Corps, or the U.S. Armed Forces, and they gave you an education benefit as a lump sum, that will be treated as a year's worth of payments. Now, only loans in the direct loan program are eligible. If you thought you were in a public service loan forgiveness, maybe you were in the income-based repayment, but you were in the FEL program, it doesn't count. And sometimes borrowers would ask their lender, am I in the income-based repayment plan? The lender would say yes, not realizing that the borrower was really asking, do my loans count for public service loan forgiveness, where the answer would have been no. And Congress hasn't done anything to address this. Now you can consolidate FELP and Perkins loans into the direct loan program to qualify, but the payment clock will start at 0. And if you include any direct loans in that consolidation loan, which you shouldn't do, it's going to reset the payment clock to 0 on those loans, because public service loan forgiveness is per loan, not per borrower. So when you get a consolidation loan, that is a new loan with a new payment clock. And of course, private student loans are never eligible. Now, we talked a bit about borrowers having trouble counting the number of qualified payments they're applying before they had reached the 120 count. But it's also true that the loan servicer has trouble counting the number of qualifying payments. I have personal experience with a few borrowers that I have helped that the loan servicer said they had 65 qualifying payments, when in fact they actually had more than 120 qualifying payments. And upon the loan servicer double checking information, they discovered that indeed the borrower had made the required number of payments. And it's important that if you believe you've made the right number of payments and you're appealing a denial of your loan forgiveness application, you continue making payments. Once you get loan forgiveness, any extra payments will be refunded to you. But if you stop making the payments and you go into default, you're going to lose that loan forgiveness. Now, at savingforcollege.com, we've added 4 income-driven repayment calculators, each of which implements public service loan forgiveness. This screen snapshot shows the result using pay-as-you-earn repayment. And it compares pay-as-you-earn repayment with standard repayment for a single borrower with $45,000 in annual income, $35,000 in student loan debt at 5% interest, a family size of 1 in the continental US, 3% annual cost of living adjustment to their income, and a 2% inflation rate. This is a whole bunch of assumptions, but they're pretty typical. And that borrower, based on this calculator, will save about $14,000 in total payments using public service loan forgiveness. They will still be making $30,000 in total payments. So public service loan forgiveness as a back-end loan forgiveness program saves you some money, but it's not full forgiveness of your entire debt. So in all public service loan forgiveness does is it removes the debt as a disincentive to pursuing a public service job by the income-driven repayment plans reduce your monthly payments to an affordable level, and the remaining debt after 10 years is forgiven, so you're not in indentured servitude. Now let's talk about LRAPs. LRAPs, or Student Loan Repayment Assistance Programs, involve an employer making a payment directly to the employee's student loans. Most employers pay $100 a month, up to $10,000, but some employers will pay more. Some do not have cumulative limits. Examples of employers that offer LRAPs include Fidelity Investments, Aetna, the health insurance company, Penguin Random House, a publisher, Staples, where you get your office supplies, NVIDIA, graphic card manufacturer, Peloton, the exercise bike company, and PricewaterhouseCoopers, a consulting firm. Now, the CARES Act added an exclusion from income for LRAPs from March 27 through December 31st of this year. So it's tax-free from March through December. The hope is that they will eventually make this a permanent benefit, but at least they made it tax-free for this year. And according to the Society for Human Resource Management, also known as SHRM, 8% of employers provided student loan repayment assistance in 2019, up from 4% in 2018 and 3% in 2015. If the tax-free status is made permanent, SHRM believes that a third of employers will offer LRAPs by 2021. So this will become potentially a much more common benefit. So now that we've talked about loan forgiveness, let's switch to loan discharge. Unlike loan forgiveness, a loan discharge doesn't need to be earned. Instead, student loans are discharged based on the borrower's circumstances. Death and disability discharges are examples where the borrower is unable to repay the debt. There are also loan discharge can occur if the borrower is saying it's not my debt and they can prove it. An example of disavowing the debt includes identity theft, where someone used your identity to borrow in your name, but they weren't you, and you can prove that you weren't the one who borrowed it. Like you might have to provide samples of your signature from that time period. Now, here's an example of several different loan discharge programs. Federal student loans offer death and disability discharges. 2/3 of private refinances offer a death discharge, and less than half offer a disability discharge. So you need to check whether the loan refinance, or if you're getting private student loans in the first place, whether they offer a death or disability discharge. For new private student loans, it's about 3/4. Now, federal student loans also offer a whole bunch of other types of loan discharges that aren't offered by private student loans. And that includes a closed school discharge, identity theft discharges, unpaid refund discharges, and false certification discharges. An unpaid refund discharge is like when you return money to the school to return to the lender, and that money was never returned to the lender. That's called an unpaid refund, and you can establish that and then get that debt, the obligation to repay that debt canceled. Because you did return it, the school just didn't act properly. So with regard to the death discharge, with student loans, it's just the death of the borrower, but with the Parent Plus loan, it's also if the student on whose behalf the loan was borrowed happens to die. The total and permanent disability discharge is just for if the borrower becomes totally and permanently disabled. With the Parent Plus loans, it's not canceled if the student becomes disabled. Bankruptcy discharge is very rare. It requires that repaying the loan impose what's called an undue hardship on the borrower and the borrower's dependents. Congress never defined what it meant by undue hardship, so it's been defined by the courts. And there are two main tests that are used. One's called the Bruner test, and the other is the totality of circumstances test. And both of them involve a current inability to repay the debt, and that this inability is likely to persist for most of the life of the loan. The Bruner test also requires that you have made a good faith effort to use all the options for financial relief that are available to you. The closed school discharge is if the school closes while you're enrolled or within 120 days of your withdrawal, you can have your student loans discharged. the ability to benefit and disqualifying status relate to student eligibility. You have to satisfy certain eligibility criteria in order to get a student loan, like you have to either have a high school diploma or a GED or the equivalent. And if you actually weren't eligible, like you dropped out of high school, never got your GED, but you went on to college, well, then you weren't eligible for the loans, and the school, in certifying your eligibility, made a mistake, and you can have those loans discharged because you shouldn't have gotten them in the first place. Now, the defense to repayment started during the Obama administration. Before then, it was only used 3 times, but it became much more prevalent during President Obama's tenure. And it basically means if the college violated state law by misrepresenting their educational services, or they engage in some type of misconduct relating to the educational services or federal student loans, then the defense to repayment, in theory, should get your loans canceled, and retroactively too, so you get refunds of everything that you paid. Well, the Trump administration hasn't forgiven any loans under the defense to repayment. There have been court cases and some court orders requiring them to do so within a certain time period, or the loans get just blanket canceled by the courts. It's still very few borrowers have, after the Obama administration, have been able to benefit from this. And then there's a discharge for 9/11 victims and public servants for their spouses and parents. So let's turn to the disability discharge. Only federal loans are eligible for the total and permanent disability discharge, but some private student loans offer something that is similar. Now, Parent Plus loans will be discharged because of the parent's disability, but not because of the student's disability. There are 3 ways to qualify: the Veterans Administration, VA, determination that the borrower is unemployable due to a service-connected disability or disabilities that are in aggregate 100% disabling. The Social Security Administration, if you're eligible for Social Security Disability Insurance, SSDI, or Supplemental Security Income, SSI, then you are considered to have a total and permanent disability if the notice of award or your benefits planning query show a next disability review date will be in 5 or more years after the date of the most recent SSA disability status determination. So if you're disabled for at least 5 years, you're considered to be permanently disabled. And then finally, a doctor who is licensed to practice medicine in the US can certify that you are unable to engage in what's called substantial gainful activity due to a physical or mental impairment that has either lasted for a continuous period of 60 months, that's 5 years, can be expected to last for a continuous period of 60 months, or can be expected to result in death. So if you have any of these 3 certifications, then your loans are eligible for the total and permanent disability discharge. And the US Department of Education and the VA and the Social Security Administration have set up an automated data match. It took them a long time to realize that this is something that they should do to enable students to automatically qualify for disability discharge if they're in either of those databases. Now, there are some subtle differences. The date of disability determination is the date that the VA made the disability determination, or the date that the disability discharge loan servicer received the Social Security Administration documentation, or the date that the doctor signed the total and permanent disability discharge. So that specifies when the loan payments, what's the start date is for that forgiveness, and then any payments made after that point will be returned to you, refunded to you. Now, with the Social Security Administration and doctor certification, but not the VA determination, there is a 3-year post-discharge monitoring period. And veterans don't go through that. And there's no monitoring period. But the monitoring period is focusing on your earnings from employment and not your unearned income. So if you have bank interest, that doesn't count against you. But if you worked and earned money, earned wages, those earnings cannot be over 100% of the poverty line for a family size of 2, regardless of what your actual family size is, and for that entire 3-year period. So if your income jumps above that threshold during that 3-year period, you retroactively lose the disability discharge. There is a website that you go to apply. It's called disabilitydischarge.com. Even though it's not a .gov, it is a government website. It's run by Nelnet, the loan servicer that manages the process. Now, let's suppose that you get your loans forgiven or discharged. Is that going to be taxable to you? So normally, the IRS considers the cancellation of debt to be as though someone gave you money and then you use that money to pay off the debt. So you got income to pay off that debt. And so you will receive an IRS form 1099-C if the loan cancellation amount is $600 or more. But there are several circumstances in which the loan forgiveness or loan cancellation is tax-free. If the loan forgiveness is for working a particular occupation, like teacher loan forgiveness and public service loan forgiveness and certain other loan forgiveness programs, then that loan forgiveness is tax-free, provided that the loan forgiveness is provided by the loan program, not a third party. And that includes loans made by the federal government, state governments, and educational organizations. The Tax Cuts and Jobs Act of 2017 established that death and disability discharges, whether by the federal government or private student loans, are tax-free through the year 2025. After that, it reverts to the old taxable status, but hopefully it will be made permanent. The CARES Act excluded employer LRAPs from income for payments made through the end of this year, from March 27 to December 31st. So that is also tax-free. Unfortunately, the cancellation of the remaining debt after 20 or 25 years in an income-driven repayment plan is taxable under current law. And so you will be substituting that remaining debt, depending on what your marginal tax bracket is, let's say it's 24%, you'll be substituting a lower tax debt for that education debt. And there are some circumstances in which you can get that tax debt forgiven by the IRS. These include if you're insolvent, which means that your total debt exceeds your total assets. You would then file IRS Form 982, and you can get more information from IRS publication 4681. Generally, it is best to have an accountant file this form because they know how to structure it appropriately. You can also make an offer in compromise if you don't qualify as insolvent, where you ask for a reduction in the amount of debt, and that would be through IRS Form 656, which again, you should have an accountant file on your behalf. Otherwise, you can get a payment plan from the IRS instead of having to make a lump sum payment, and that's for up to 6 years, and you would file IRS Form 9465 in order to apply for that. So now let's talk about the HEROES Act. The HEROES Act was passed by the House on May 15 of this year, 2020, and it includes proposals for loan forgiveness, up to $10,000 for federal student loans and up to $10,000 for private student loans. And it would be implemented with the forgiveness of federal loans occurring immediately after enactment as soon as practicable. The forgiveness of private student loans would occur within 90 days after September 30th of 2021. And the amount of forgiveness would, for the private student loans, would be reduced by the extension of the payment pause and interest waiver to private student loans. the forgiveness, I mean, before they passed the final law, they limited it to economically distressed borrowers. And I don't think this is going to end up in the final legislation, unfortunately. But final legislation is going to require a compromise between Democrats and Republicans, because neither side can pass legislation in the Senate on their own. There are the HEALS Act that was introduced by Senate Republicans recently, which doesn't include any loan forgiveness or even an extension of the payment pause and interest waiver, doesn't have enough votes. There are 20 Republicans who don't want to do any further financial relief due to the pandemic. So the only way the remaining Republicans can get their legislation passed is with Democratic cooperation. And the Democrats have already made their proposal in the House. So there's going to have to be some sort of a compromise. The Democrats want $3 trillion, the Republicans want $1 trillion. The final result will probably be somewhere in between. I think it will probably include an extension of the payment pause and interest waiver, but I don't think it's going to include loan forgiveness, because Republicans don't like loan forgiveness, even for public service, whereas Democrats are strongly in favor of it. But who knows what will happen? There's a lot of horse trading that goes on in these things. Now, to qualify for this, you might have had to have income under 150% of the poverty line to be considered economically distressed. That's $19,000 and change for a family of one, $25,000 for a family of two, plus a little bit more than $32,000 for a family of three, and more than $39,000 for a family of four. But it's very expensive, which is another reason why it might not make it into the final legislation. Let's move on to other loan forgiveness proposals. So both presidential candidates have their own proposals for relating to loan forgiveness. Joe Biden has several. He's proposed loan forgiveness for tuition-related federal student loan debt for undergraduate student loan borrowers who are earning less than $125,000 a year. They must have attended a public college or university or a HBCU or MSI. Graduate student loans and private student loans are not eligible. He's also proposed a new version of income-driven repayment. Politicians seem to love income-driven repayment, and they want to create their own variation, even though the existing plans are adequate, and what we need is to just get rid of the ICR and IBR and repay, and just have everybody eligible for pay-as-earn repayment, which is the most favorable of the plans. But in the HEALS Act, they proposed income-determined repayment. Joe Biden wants his new income-driven repayment, because they all love it and they want to be able to call it their own. And so he would cut the monthly payment in half and provide tax-free loan forgiveness after 25 years in repayment. He's also proposed a new version of public service loan forgiveness that would replace it with an upfront loan forgiveness program instead of a back-end loan forgiveness program. And he also supports now bankruptcy discharge of student loans, even though earlier in his career he was opposed to it. On the other hand, Donald Trump in every single budget has proposed repealing public service loan forgiveness. Broad loan forgiveness forgiving all debt of all borrowers is extremely unlikely, because not only, if he were to propose it, not only would he have to convince the Republicans, but he would also have to convince the Democrats. Of the 25 Democratic candidates for president, only 4 of them proposed widespread loan forgiveness. Now, it is potentially a bipartisan issue, because one Republican who was chief operating officer at the U.S. Department of Education supports loan forgiveness as a means to getting the federal government out of making student loans. It would replace the loans with grants, $50,000 in student loan grants, in student grants instead of federal student loans, spread all across the undergraduate education. which would then, there would no longer be a need for federal loans, and instead, for people who already have graduated and they still have loans, he would forgive up to $50,000 of those loans. He's running for for the Senate in, I think it's Georgia. So that's part of his platform. Thank you. We will now open it up to questions. We have our student loan section with more than 500 articles at savingforcollege.com/student-loans. And there's also the student loan newsletter that you can sign up for, where whenever we publish new articles, and we're doing them at a pretty fast clip, they will be publicized in the newsletter. So you can learn the answers to questions that I'm unable to answer during this Q&A period. So now to Julian.
Awesome, thanks a lot, Mark. So we got a few questions here. Let's start with a complicated one. So this person is asking, I have a client who is considering medical school. What would you recommend with the best types of loans? What do you recommend for repayment? I've seen where they recommend doing the income repayments and then making contributions to retirement accounts. Granted, her income-based repayment will be high, but if she has the ability to balance, the ability for the balance to be forgiven, that would be a better strategy than trying to aggressively pay off the loan, right? Please advise.
So federal student loans, particularly the federal direct Stafford loan, is cheaper than private student loans. There is some play in the joints where if the borrower has excellent credit and the private student loans may be less expensive, slightly less expensive than the Grad Plus loan. But if they're going to be pursuing loan forgiveness, you can get loan forgiveness for the Stafford and Plus loans, but not for private student loans. Now, after 4 years of medical school, most medical school graduates go through internship, residency, and maybe also a fellowship. And this can take as much as 4 or 5 years. During that period, you may be earning a relatively low salary for a doctor at $50,000, $60,000 a year. That's high for most of us, but for a doctor, that's relatively low, especially compared to their debt, which is usually in the 6 figures. So if they're in an income-driven repayment plan during that time, they're earning some forgiveness because most internships and residencies are at public or nonprofit hospitals, which are a qualifying employer. So you would be earning 4 or 5 years of loan forgiveness based on the fact that you have high debt and low income. Then after you get your 6-figure salary, if you continue working for a nonprofit or tax exempt or public hospital or other tax exempt organization for just 5 years, and the remainder of that 10-year period, then you will probably have income that exceeds your debt, so your monthly payment will not be reduced if you're in, it'll be the standard 10-year repayment amount, depending on your income-driven repayment plan. And so that will preserve the forgiveness that you already earned. And so you can probably get tens of thousands, if not 6 figures worth of student loan debt forgiven because of that. I call it partial student loan forgiveness. First wrote about this over a decade ago. As far as which repayment plan, pay-as-you-earn repayment has the lowest monthly payment. Revised pay-as-you-earn repayment has a marriage penalty and doesn't cap the monthly payments at the standard 10-year repayment amount. So that's more expensive for you. So if you have a choice, if you're eligible for pay-as-you-earn repayment, choose that. If you're not, because your loans were made, don't qualify the cutoffs, and you have to have no loans prior to October 1 of 2007, and at least one loan dispersed on or after October 1 of 2011. If you don't meet those criteria, then either income-based repayment or revised pay-as-you-earn repayment will yield the lowest monthly payment, but you have to model in the income increase because income-based repayment has a cap at the standard payment 10-year payment amount, whereas revised pay-as-you-earn repayment does not.
Got it. Got it. Another question here: does Trump's executive action apply to federal loans that are serviced by the likes of UHEAA, et cetera?
No. Loans that are serviced by a guarantee agency like UHEAA are in the FFELP program, the Federal Family Education Loan Program. Those loans are not eligible. However, if you consolidate those loans into the direct loan program, they will be eligible. So FFELP loans and Perkins loans, if you consolidate them into direct loans, they become direct loans, and all direct loans are eligible. There is one exception for FFELP loans, and that is loans that were made in 2008-09 and 2009-10, for which title to those loans were transferred to the U.S. Department of Education under the Ensuring Continued Access to Student Loans Act. Those loans, known as the CASA loans, are FFELP loans, but they are held by the U.S. Department of Education and therefore are eligible for the payment pause and interest waiver.
Makes sense. Sort of a changing gears here. Somebody said, I'm a mom who isn't currently working due to taking care of my disabled child. Is there any forgiveness or discharge for this situation? Married, husband is currently the only one working.
Unfortunately, for the Stafford and Plus loans, no. The Perkins loans at one point had a loan forgiveness program that and a deferment program that might be eligible, but very few people do qualify for it. If you're in an economic hardship deferment, the time spent in that economic hardship deferment does count towards the 20 or 25-year forgiveness under the income-driven repayment plans, but it does not count towards public service loan forgiveness. Unemployment deferment doesn't count for either.
Got it, got it. The other one here, what loan do you suggest for a teacher's assistant? I was one for the past 3 years, paid off my loan until March when the act was passed.
So if you're getting a student loan, regardless of your occupation, borrow federal first, because the federal student loans are cheaper, they're more available, and they have better repayment plans. And also better deferments and forbearances, options for loan forgiveness. And there are a lot of superior benefits associated with federal loans that aren't available on private student loans.
Okay. Another one here, should PSLF eligible borrowers make payments after September 30th under the current memorandum by Trump?
Right. So it remains to be seen whether the executive order's extension for 3 months, one, passes legal muster, and two, whether it counts towards public service loan forgiveness. My opinion is that it doesn't pass legal muster, but I don't think anybody's going to challenge it specifically because nobody wants to be seen as being anti-borrower. However, there are 3 other executive orders that are likely to be challenged in the courts. And if they challenge them, they're probably going to throw this one in as well, simply so that the courts don't say, well, why aren't you challenging this one on constitutional grounds as well? And the problem is that the extension was going to cost federal government $15 billion to do that 3-month extension where they forgo student loan interest. That's money. And the White House doesn't have the authority to appropriate funds. Only Congress does. And there is no pile of money that for another purpose that can be shifted towards covering this benefit. And so that's where the legality, the first problem with it. And then there's more technical issues with the specific authorities to waive and modify the terms of the student loan, where it's often taken out of context, saying, oh, look, the government, the Secretary of Education can modify the terms of these loans. But if in the preamble of that section, it very clearly specifies that it's in carrying out the duties, which means it's confined by the statute. So any restrictions put into place by Congress that were already existing, they can't waive them. There's also something called a different HEROES Act that provides authorities during a natural disaster to waive and compromise certain capabilities. But again, and there's a statutory restrictions that they generally have to work within. And it remains to be seen what's going to happen as far as the whether you should make the payments to count towards public service loan forgiveness. 3 months isn't going to make a big difference either way. So if you wait, if you have 3 months additional wait until your loans are forgiven, you have 3 months. And the key is, are you capable of making those payments? And before you start using the freed up money to make those payments, which will go entirely to principal, which is another reason why you might not want to do it, because you're just reducing the amount that will ultimately get forgiven. The other issue is, well, you're still working, but who knows if you're still going to have a job in a month or two, because this pandemic is not ending anytime soon, and we won't have a proven safe and effective vaccine until next year. And so first thing your priority should be is to build up an emergency fund with at least half a year's salary, maybe as much as a year's salary, so that if you lose your job, you have some money to live off of.
Got it. Switching a little bit, going more into the teacher loan forgiveness stuff. Somebody asked, can you qualify for teacher loan forgiveness more than once if you move to and teach in another state?
Potentially, yes, but it has to be with a different requirement. And it's complicated. You can also potentially stack teacher loan forgiveness and public service loan forgiveness, where you would do the teacher loan forgiveness first, 5 years of service to qualify for that. Then you would do public service loan forgiveness, an additional 10 years to qualify for that. Obviously, you can't do it the other direction because public service loan forgiveness forgives the entire amount of debt. And so there's nothing left for teacher loan forgiveness to forgive. The reason why someone might want to do this is if they're unsure of their commitment to a teaching career, and so they want to give it a try for 5 years, get some forgiveness, and then decide if they want to continue. Though they could always, when it's time for them to get that teacher loan forgiveness, if they decide that they are going to pursue it as a career, they could forgo the teacher loan forgiveness at that point and just continue on for another 5 years to have the remaining debt forgiven. The issue with getting teacher loan forgiveness twice is you have to be with different loans. Can't be with the same set of loans. So if you got a bachelor's degree, taught in one field, then you got another bachelor's degree with a new set of loans and taught in a different field, yes, you could probably qualify for that. There are a lot of details that would affect that.
Got it. We have another specific case here. This person says, I'm thinking of paying medical school via enlisting in the National Guard. I already have loans under my name and a Parent Plus loan under my dad's name. Is it possible to transfer the Parent Plus loan money from the parent to the student's name so that the National Guard can pay for them?
No, you can't change the title of those loans. There was one loan repayment program where you could get loan forgiveness for Parent Plus loans that were used to pay for the education of someone who was enlisted, but I don't think it was from the National Guard.
Got it. Another specific scenario here. This person says, my grandson was diagnosed with bipolar disorder and manic before his 22nd birthday. Who should we talk to about help with student loans?
Okay, well, if he is unable to hold a job because of his disability, then he should consider applying for a total and permanent disability discharge. He'll need a doctor's certification that he is unable to participate in substantial gainful employment. Though to the extent that that disability can be controlled through medication, he might not qualify for it. So a lot depends on whether there's a doctor who's willing to sign the form asserting that he is unable to work because of his disability. Because even with medication, sometimes the disability can be so severe that you are unable to hold down a job. And the mood swings and all that can make it really difficult to work a job.
Okay. Another specific question here, more on forgiveness. Can you sign up for pay or repay on undergrad loans while you are in grad school?
Yes. Your obligation to repay the loans is suspended while you're in graduate school, and any payments you make during that in-school deferment will not count towards the loan forgiveness. But payments that you made before you went to graduate school, while you were in pay or repay and working full-time in a public service job, those do count. And remember, the loan forgiveness is per loan, not per borrower. So what that means is that your undergraduate loans may qualify for loan forgiveness after you graduate from graduate school before the graduate school loans do, because they may have had a few years head start. So you may have, you get some loans forgiven, and then you continue working for a few more years, and you get some other loans forgiven.
Got it. And we're right about a minute away from close, so I think we're gonna call it there. Thank you everybody who submitted questions. We got a lot of them. Just echoing what Mark said at the start of this webinar, he is very diligently writing answers to everything that you guys have asked, so that will be answered either via a future webinar, a future article. So I do suggest that that link I sent all of you guys, the statementforcollege.com -student-loans, very much recommend you go on there. There's a lot of tips and advice to check out. And Mark, do you have any final thoughts for the audience?
No, and we've written more than 530 articles about borrowing and repaying student loans on our website. So we're not just about saving for college. I mean, if you haven't saved enough, you're going to have to borrow. So we want to provide you with good advice on that. And so there's a lot of material on our site about everything you could possibly want to know about student loans, not just 529 plans and saving for college. And we also have FAFSA information, we have scholarship information, and we're effectively a full service website for all aspects of saving and paying for college.
Great, thanks a lot, Mark, and thank you everybody for joining.